The global banking system can feel like a genuine enigma. There are more than 30,000 individual banks operating worldwide, and between them, they control a genuinely staggering amount of wealth. The 10 largest alone hold something in the neighborhood of $25 trillion in combined assets. Modern banking can look impossibly complicated from the outside, but the whole idea actually started out as something much simpler, a solution to a very ordinary practical problem. That story begins in 11th century Italy, which had become the beating heart of European trade. Merchants from all across the continent converged there to buy and sell goods, but they ran into one persistent headache. There were simply too many different currencies in circulation. In the city of Pisa alone, traders had to juggle 7 different kinds of coin, constantly converting one into another, just to do business. This currency exchange work usually happened right out in the open, on wooden benches set up in the street, and that detail turns out to matter, because the Italian word for bench, banco, is where the word bank actually comes from. The everyday risks of the job, the danger of traveling with cash, the constant threat of counterfeit coins, and how genuinely difficult it was for anyone to secure a loan, eventually pushed people toward a completely new way of doing business. Pawnbrokers began extending credit directly to merchants, while traders in Genoa pioneered early cashless ways to pay for things, using written bills of exchange that let a merchant settle a debt in one city by drawing on funds held in another, without ever physically moving the coins themselves. Networks of these early banks gradually spread across Europe, eventually extending credit to institutions as powerful as the church and to European royalty themselves. By the 15th century, the Medici family in Florence had turned banking into something close to an art form, building one of the most powerful financial institutions in Europe and helping popularize double-entry bookkeeping, a way of recording every transaction twice, once as a debit, once as a credit. That made it dramatically harder for a bank's own books to quietly fall out of balance without anyone noticing. Much of the basic accounting infrastructure modern banks still rely on today traces its roots directly back to innovations like that one. A little further north, the Fugger family of Germany built an equally staggering fortune over the following century, financing kings and even helping bankroll the election of a Holy Roman Emperor, which shows just how quickly private banking families had become genuinely central to European political power, not just commerce. By 1694, banking took another decisive step forward with the founding of the Bank of England, one of the first institutions to formally combine private lending with a quasi-official role managing a nation's currency and government debt, an early blueprint for what a modern central bank actually does. Over the following centuries, most countries eventually built their own version of this idea, tasked with controlling the money supply, setting interest rates, and acting as a lender of last resort when private banks got into trouble. The United States didn't establish its own central bank, the Federal Reserve, until 1913, following a string of earlier financial panics that convinced lawmakers the country genuinely needed one. So what does all of that actually look like today? Stripped down to its essentials, a bank is fundamentally in the business of managing risk. Here's the simplified version of how it works. Ordinary people deposit their money with a bank and earn a modest amount of interest in return. The bank then turns around and lends that same money out to other people at a considerably higher interest rate. It's a calculated bet because the bank already knows that some fraction of those borrowers will inevitably default and fail to repay what they owe. This entire mechanism turns out to be genuinely essential to how a modern economy actually functions, because it's what allows ordinary people to buy homes and lets businesses raise the capital they need to expand and grow. In effect, banks take money that savers currently have no use for and convert it into funding that the rest of society can actually put to work. Beyond that core lending business, banks also generate income in plenty of other ways, accepting savings deposits, running credit card operations, trading currencies, offering custodial services for other institutions' assets, and providing cash management for businesses. The real trouble with a lot of modern banking is that many banks have quietly drifted away from that traditional, patient role of providing long-term financial products in favor of chasing much riskier, faster short-term profits instead. During the financial boom leading up to 2008, many of the world's largest banks began trading in complex financial instruments that were barely understood even by the people selling them, chasing quick profits and enormous bonuses for their own executives and traders in the process. A big part of the mechanism worked like this. Banks bundled together thousands of individual home loans, including a large number of so-called subprime mortgages handed out to borrowers, who realistically had little chance of ever repaying them, and repackaged those bundles into complex investment products that credit rating agencies then, mistakenly, stamped as extremely safe. Those bundled products were then sliced up and sold on to other banks and investors worldwide, which meant that when the underlying loans inevitably started failing, the resulting losses didn't stay contained in one place. They rippled outward through practically the entire global financial system at once. It amounted to little more than high-stakes gambling, and it ended up doing real damage to entire economies and societies. Banks like Lehman Brothers extended credit to nearly anyone who wanted to buy a house, regardless of whether they could realistically repay it, which left the bank sitting on an extraordinarily dangerous pile of risk. When that risk finally caught up with the system, it triggered a collapse in housing markets across the US and large parts of Europe, sent stock prices plummeting, and spiraled into a full-blown global banking crisis, one of the largest financial crises in modern history. Hundreds of billions of dollars simply evaporated. Millions of ordinary people lost their jobs and their savings along with them. Most of the world's major banks were eventually forced to pay out billions of dollars in fines, and bankers as a profession became some of the least trusted people in the public eye. Governments in the US and across the European Union had to assemble enormous bailout packages just to buy up the bank's bad assets and keep the entire system from collapsing outright. In the aftermath, new regulations were put in place to govern how banks could operate going forward. In the United States, that meant a sweeping new law known as Dodd-Frank, while internationally, regulators agreed on a tougher set of standards called Basel III, both aimed at forcing banks to hold significantly more of their own capital in reserve rather than operating on the thin financial margins that had made the 2008 collapse so contagious in the first place. That included mandatory emergency reserve funds specifically meant to absorb shocks if another crisis like this ever happened again. But not every proposed reform actually made it through. Several other pieces of tough new legislation were successfully blocked by lobbying from the banking industry itself. Today, other ways of financing people and businesses are steadily gaining real ground. Some newer investment banks now charge a flat yearly fee instead of earning commissions on the products they sell, which actually aligns their financial incentives with genuinely acting in their clients' best interests, rather than pushing them toward whatever product happens to pay the bank the most. A related idea, peer-to-peer lending, cuts out the traditional bank almost entirely. Online platforms match individual borrowers directly with individual lenders, letting ordinary savers earn a return by funding someone else's personal loan or small business, without a bank sitting in the middle taking its own cut along the way. More broadly, an entire wave of financial technology companies, often shortened to Fintech, has emerged over the past decade or so, offering digital-only banking, instant mobile payments, and automated investing tools that increasingly compete directly with services traditional banks used to consider entirely their own. Credit unions offer another real alternative: cooperative institutions that were originally established back in the 19th century specifically to help ordinary people avoid predatory lenders. In practice, credit unions offer largely the same financial services a bank does, but they're built around shared value for their members rather than pure profit maximization. Their stated purpose is to help members create real opportunities, starting a small business, expanding a family farm, or building a home, while reinvesting profits back into the communities they actually serve. Members themselves control credit unions, and they democratically elect their own board of directors. These institutions vary enormously in scale worldwide, from tiny operations with a literal handful of members to organizations managing several $billion and serving hundreds of thousands of people. Because credit unions are so focused on benefiting their own members directly, they tend to take on meaningfully less risk than traditional banks do, which helps explain why, even though they didn't escape the 2008 crisis entirely unscathed, credit unions came through it in noticeably better shape than most conventional banks. Then there's the explosive rise of crowdfunding over the past decade or so. Beyond making countless independent video games and creative projects possible, crowdfunding platforms let people borrow directly from large pools of small individual investors, cutting the traditional bank out of the transaction entirely as a middleman. It works just as well for actual industry. plenty of now successful technology companies got their real start on platforms like Kickstarter or Indiegogo. A newer variation, sometimes called equity crowdfunding, goes a step further. Instead of just receiving a product or a reward for pledging money, backers actually receive a small ownership stake in the company itself, giving ordinary individual investors a way to buy into an early-stage business that would once have been accessible only to professional venture capitalists. Everyone who contributes gets to feel like part of something bigger, gets to back ideas they personally believe in. And because the financial risk is spread across so many small individual backers at once, the damage stays genuinely limited if any single project ends up failing. And finally, there's the rise of microcredit. Large numbers of very small loans, typically extended in developing countries, specifically designed to help people work their way out of poverty. People who had previously been shut out of the traditional financial system entirely, simply because a conventional bank never considered their tiny loan worth the paperwork. The idea is closely associated with the Grameen Bank, founded in Bangladesh in the 1970s by the economist Muhammad Yunus, who started by lending small amounts of his own money directly to poor villagers so they could start tiny businesses of their own. The results were striking enough that the approach eventually earned Yunus and the Grameen Bank a joint Nobel Peace Prize and inspired similar microcredit institutions across dozens of other countries. Today, granting microcredit has itself grown into a genuine multi-billion-dollar industry in its own right. So banking, as an industry, might not be the most thrilling topic in the world, but the fundamental role banks play, channeling funds from people who have them to people and businesses who actually need them, remains absolutely essential to how society functions, and someone, in some form, is always going to need to do it. From benches in a peasant street market to central banks setting interest rates for entire nations, to apps that let you split a dinner bill in seconds, the underlying job has stayed remarkably consistent even as the tools have changed almost beyond recognition. Exactly who ends up doing that job, and exactly how they end up doing it, is still very much an open question, one that's genuinely up to all of us to help decide.